Are your sales good enough? Are they high enough to franchise your business? Your sales and the economic performance of your business should play a critical role in evaluating franchising and whether or not your business is ready to franchise. So, a question comes up often, and when someone evaluates franchising their business, sales play a critical role. Why? Well, as a new franchisor within your FDD, one of the most important data points that you're going to be sharing with franchisees or franchisee candidates are item 19 financial performance representations, where you advise the public, you advise potential franchisee buyers of your own performance, the gross sales of your business, possibly cost of goods sold, or if you're a restaurant, food costs, labor cost, gross profit. And why do we do that? Well, someone who's going to buy a franchise, potentially invest their livelihood in savings, they at least need to know how you're performing and the unit economics of your business. So how do we decide if sales are good enough? The first thing to know is that just the number, your sales by itself, that's not enough to know. So there's a couple of evaluations that we go through with our clients before even onboarding with them or accepting them, or sometimes advising them that they're just not ready to franchise. So in this universe of evaluating economics, deciding whether or not your sales or your economic numbers are good enough to franchise, let's create some categories here. Your gross sales, which are the overall sales of your business, your operating costs, which are, for example, your cost of goods sold, or if you're a restaurant, your food cost, and then your labor cost, and your operating profits, right? So those are top line numbers: gross sales less cost of goods sold and operating profits. That should be the initial building block of data that you should be evaluating when deciding whether or not you should franchise. So let's say we have really good sales numbers. We have what we believe good cost of goods sold and labor cost. And when I say good cost of goods sold, I mean our ratios of our cost of goods sold relative to gross sales, they're favorable. And we have a pretty good operating profit number. The real key to this evaluation and the ultimate question that we need to be answering is, based on our financial performance, one, can a franchisee replicate that performance? And maybe it's not going to happen in year one or year two, but is there a good pathway for the franchisee to replicate your financial performance? And if they do, will they be profitable? And will they generate sufficient cash flow and income? And when you're making that evaluation, you also need to consider that franchisees are going to have higher costs than you. Right out of the gate, they're going to have a royalty fee that they're paying to you. Supply chain and other expenses may be slightly increased relative to what you're paying right now. So at a baseline level, the most important step to evaluate is, what do our sales look like? What do our profits look like? What do our margins look like? And if it's replicated by our franchisees, will they be profitable? Will they generate sufficient income, even after accounting for the fact that they're going to be paying us royalties and other fees? So that's the baseline, very superficial analysis. So now let's dive a little deeper. We have our baseline analysis of, hey, our economic model is viable, it's profitable, and can be replicated by franchisees. Okay. Now, next is we need to evaluate your economic performance and benchmark it with your competition, with the industry, and what I'll call franchising factors. So let's start with industry. Overall, how do your gross sales compare to other businesses within your industry? Are you a top performer? Are you at a mid-level number? And are your metrics consistent? What are good financial performance factors within your industry? And I'll use a very basic and common example. If you're a restaurant and you're in a fast casual segment, well, based on the square footage of your restaurant, how well are you performing, right? If you're a 5,000 square foot location restaurant and your numbers are the same as someone who operates from a 2,500 square foot restaurant, your ratios may be out of sync. So at the first step, let's make some industry comparisons. Are you doing well in your industry? What do your KPIs look like? So if you're a retail-based business, what's your rent factor look like? What is your square footage? Again, from a general sense, we want to see how competitive you are and the fact that you're outperforming the competition or you have that ability. Next is the actual competition. So an exercise that we frequently undertake with potential clients when we're evaluating the franchising process, we look at their prior 2 years sales, potentially cost of goods sold and gross profit numbers. And then what we do is we evaluate and we go through competing brands in the franchise industry. So if you're in the coffee space, or if you're in the restaurant space, or you're in a service-based business, let's look at some entrenched competitors that are thriving and growing as franchise brands, and let's look at their item 19 financial performance representations. Now, you're just maybe 1 or 2 units, you haven't franchised yet. These larger franchise brands are they're going to have an item 19 that gives maybe company-owned data and franchisee outlet data, maybe averages. But let's at a superficial level, how do your sales, how do your unit metrics compare to what your competition is disclosing in their item 19? Are your sales in the top 50% of what another franchise is reporting for their franchisee sales? So we're going to want to make those benchmark comparisons to competition. So we start with baseline metrics. What are your sales? What are your cost of goods sold? What is your gross profit? How do you look within the industry in terms of your unit metrics? What is your competition promoting and reporting in their item 19? And are we competitive with those brands? If we're not, let's evaluate why not. And if we are, that's sort of a check mark that goes into the positive column of, hey, our financial performance is good enough. But there's more to this evaluation. Next is, if we do franchise, and let's assume we support our franchisees, we start slow, right? Years 1 and 2, we sell organically. The people that know our brand, right, are passionate about it. We over support them. If we do that and we help them select the right markets and the right locations, can they replicate your success? Now, it may take time, but it's key that they have a pathway where if they do well and we support them the right way and they're in the right markets, that they can replicate your performance and maybe even surpass it. And that's also common, right? We have clients that operate in difficult markets and yet have really good sales and really good performance. And then when they franchise and a franchisee enters maybe a more populated market, a market that supports higher price points, the franchisees thrive. So can it be replicated by franchisees? Now, let's get into the relativity of your financial performance. And this is something that I think many startup franchisors and franchise consultants overlook or get wrong. But for you, you're an entrepreneur, you're now potentially entering the franchise space. Are your sales good enough? So what I'm going to tell you is, just knowing your numbers and your margins and other things that we discussed, you're competitive, you're meeting industry standards or exceeding them, and your numbers can be replicated by franchisees. But now from a franchise sales and franchise success perspective, let's get into some relativity, which is how well your franchise offering, your numbers present or translate as a franchise model. So a baseline is, what's your estimated startup expenses? So if one franchise brand, if your gross sales are $1 million versus someone else, and maybe in another industry, whose sales are only 200,000, the fact that you have $1 million and someone else has 200,000 in sales, just knowing that by itself is not enough. What we also need to know is, what's the estimated startup expense and potential ROI for your franchisees? So if your gross sales are $1 million, and we think over time a franchisee can scale to that type of gross sales, well, an important question is, how much money is the franchisee investing to get to that level? If it's a brick and mortar business where the franchisee has to lease a location, build out a location, and invest $500,000 or $1 million in capital, well, then that's an important factor to evaluate in determining whether or not your $1 million in gross sales are good enough. Likewise, if you're a service-based business that someone can operate from home and your startup costs are low, yet your gross sales are $1 million, well, now you have a very big balancing factor, which is I have a low startup cost business that could achieve $1 million in gross sales, which means the ROI on that initial investment will be returned or earned at a much quicker ratio than the brick and mortar business. Now, there's balancing there. Doesn't mean brick and mortar is better than a service-based business. The point here is evaluate what your estimated startup expenses are, right? How much does a franchisee have to invest to get this business up and running? And then what's that cost relative to that gross sales potential? And how long will it take a franchisee to at least not recover, but generate sales that match its initial investment? And then ultimately, when we talk about operating profits or potentially cash flow and EBITDA, how long does it take them to recover their initial investment? So you need to evaluate your sales relative to your startup costs. In the franchise world, where do we disclose startup costs? It's going to be in item 7 of your FDD. Item 7 is estimated startup expenses, all the expenses a franchisee is expected to incur from the date they sign the franchise agreement to the date they open the franchise business, and even 3 months of reserve capital. So we like to evaluate potentially gross sales and operating profit potential relative to estimated startup expense and what's that ROI. Smart franchisees, multi-unit franchisees, they're going to be looking at that ROI factor. Now, in the relativity index, when we're evaluating sales and its application to being a good franchise, we also have to get into expectations of the franchisees. And this is sort of similar to the estimated startup expense. There's different types of franchise opportunities out there. There's different reasons why people buy franchises. So there's income replacement, high investment franchises. Typical example is a restaurant, right? The person that buys a restaurant is eventually looking for income replacement, wealth building. They're probably going to make a very significant investment in starting up the business, right? And so their evaluation of gross sales and your evaluation of are your gross sales good enough to franchise should be, well, if I have a franchisee that's making a significant capital investment, who has an expectation of income replacement, well, beyond my sales and my operating profits, what does that pathway, financial pathway, look like for that franchisee to get to positive cash flow and start recouping and generating ROI, right? So I guess the point here is that it's not just your gross sales, it's that ROI. So if you're a restaurant that has lower gross sales, but higher margins and smaller footprint and a lower estimated startup expense, well, you actually may be more competitive with restaurants or other competing brands that have higher gross sales. The point being, it's relative, right? The other type, so you have income replacement. You also have franchises that are sort of lifestyle based. They're usually lower startup franchises. They usually serve a mission or purpose, whether it's community, children, education, entertainment. They're businesses that sometimes are potentially just operated on weekends, where your franchisee expectation may be different. It may not be income replacement. It may be to supplement their lifestyle. It may be community building. It may be generating just a second income. Why is that important to know? Because, well, we're evaluating, are your gross sales good enough to franchise? Well, that by itself, you need to evaluate why someone's buying your franchise and their expectations. So foundational items, when you're evaluating franchising your business, sure, we have to evaluate your gross sales And from financial KPIs, we should also be evaluating your cost of goods sold, potentially your labor costs, but that's a big variable, your operating profit. Sometimes we even go deeper and go through operating expenses and show actual cash flow numbers. Now, you have those metrics. Are they good enough? Well, compare them to industry and industry KPIs. Let's look at your competition, and specifically your competition that are succeeding in franchising, and what are the item 19 financial performance representations they're making. Next, from an operational standpoint, in time, provided we grow organically and wisely, will franchisees be able to replicate this success? And then from a relativity standpoint, what do our gross sales look like relative to our estimated startup expense, relative to potential ROI a franchisee will generate, even after we account for higher expenses like royalties, what we call franchise-related expenses. And then ultimately, what is the positioning of your franchise? Is it for income replacement? Is it lifestyle-based? And what would the expectations of your franchisees be? Because for them, we're measuring success, right? When you franchise your business, it's about empowering franchisees, helping them succeed, and really taking on an obligation. So sales, evaluating them, it's relative. And these are the factors that you should be evaluating and considering when you make the decision about franchising your business.